Welcome back to the Baird Retirement Management Show. Joining us once again is Greg Ashcroft and Scott Bartosh, who will be tackling another Financial Mythbusters segment. Let's jump right in. Scott, is the 60/40 portfolio dead?
I'm going to go with no, Hannah, with the caveat that it depends on what you want it to do. As a general concept, if you have no better ideas, you have no guidance, you don't work with somebody who can help you in terms of determining what your allocation is, I would say no, it's definitely not dead, because what it's going to do is it's going to give you exposure to what has been over the course of, 100 years, one of the better performing indexes, the S&P 500. You're going to have 60% of your portfolio in something that could do high single-digit returns, has a history of doing high single-digit returns. You're buying the biggest and the best companies in the United States. So that's not a bad idea. I'm okay with that idea. On the other side, the 40%, this is where in 2022, people got beat up. Mm-hmm. They got hammered because interest rates had really been declining since the early 80s. And because of that, even though your bond portfolio, which in a 60/40 portfolio, 40%, I'm assuming that the 40% in this description is the Barclays aggregate bond index.
Some kind of total bond index.
Yeah, total bond index, Barclays Ag, something like that. That 40%, it kind of limped along with really low interest rates, and it did okay for a long time because interest rates were generally declining. In 2022, intermediate interest rates went from 2 to 5.5 really, really quickly, and that led to this discourse, and there was a big piece in the Wall Street Journal about the 60/40 portfolio being dead. It fell dead for about 18 months there, but no, it's still a reasonable way to allocate money. Greg, some thoughts on that?
Yeah, and I think that when they said it was dead is it failed to meet the heavy expectations that you've laid out that were placed upon it. Is the 60/40 portfolio, and if we talk about the history of how the 60/40 came about, I think there's kind of an academic perspective and then there's a behavioralist perspective. The academic perspective would argue 60/40 portfolios were the creation of Harry Markowitz with mean-variance optimization. And that all that is saying, it's a fancy way of describing a portfolio that gives you enough total return with not too much variability. So you are trading variance for return in this portfolio, and people are like, where do we optimize those things? And the 60/40 portfolio was born as a really great sort of answer to that question. The behavioralist would say, no, I don't think that's how it worked at all. I think people, just by way of trial and error, were saying, well, if I own too many stocks, my portfolio goes up and down. It's all euphoria and terror. Don't love that. If I own just bonds, I'm not going to keep up with inflation. My total returns are just not ever going to be that great. So I've developed a strategy where I don't get too afraid of looking at my account balances every day. And I'm also pretty happy with what my total returns in my portfolio have been.
Yeah.
And so that 60/40 model, whether it's been developed academically, purely academically, or just from a behavioralist perspective, doesn't really matter. What people have learned that it would do, and this really was true for a long time, as Scott said, particularly as interest rates were falling after, the early 80s?
Yeah.
When they kind of peaked out. If you owned a bond portfolio, particularly if you owned a bond portfolio with a more static duration as opposed to a dynamic duration, and we'll unpack that for you here too, you benefited a lot from interest rates coming down because your bonds just continued to appreciate in price, and stocks did pretty well all the way up through, the 80s. We had the flash crash of 87. Notwithstanding that, you rode that tech wave up, and then obviously we had that big fall off, tech crash, financial crisis. But even throughout that financial crisis, if you were constantly rebalancing your 60/40 portfolio, you didn't do bad. You didn't do terribly.
Well, and I think one of the things that was different about 2022 was typically because we've been in a, disinflationary environment generally since the 70s, is that when really bad stuff happens, like the tech crisis and, the late 90s, early 2000s, the financial crisis, COVID in 2020, typically correlations, which is how are different assets going to react to each other, and are they going to move in concert, and how they are going to, reprice based on things that are happening in the market. Correlations tend to increase when bad stuff is happening. But what we saw typically was in 2001, 2008, 2020, they would kind of move in one direction. People would, kind of sell everything at the very beginning of a crisis, but then bonds and stocks would kind of separate in terms of their correlation. What we saw in 2022 that has really kind of lasted it to the present day to a degree is they went down together and they stayed down together. And because interest rates are higher, we're in this kind of post-inflation world after COVID now. I think there's some thought that correlations could be higher and bonds may not be a great hedge against stock performance on a go-forward basis.
Yeah, and I think that might militate against saying, hey, is that 60-40 portfolio going to provide me that ballast against variability or variance or volatility in my portfolio as it has done historically on a go-forward basis? That's yet to be seen. We're not going to, if we try to predict the markets, it makes astrology look like a good endeavor. But I think Scott and I were just talking about this before we started recording. You think about people who are retiring today into the interest rate environment, and you've got some hangups with inflation and whether or not our assumptions as to if it's under control or not, if those are valid. I think there's some really good evidence to suggest that not quite. So rates could still creep up a little bit from here. But if you're retiring today, the 60-40 portfolio looks pretty darn attractive.
I think so.
Because valuations might be a little stretched on the equity side, but I think if you could rewind the clock, if we had launched this podcast at the end of 2023, we would have been saying that then too.
Yeah, and not as stretched, but yes.
Well, of course.
We weren't predicting
20% year. 24%. Yeah, so we got 20% in stocks, but even on really stodgy short to intermediate bonds, you clipped 5%.
Yeah, and I think that's one of the big differences. So the two things here. One, the 60-40 where the Barclays Ag is the index for the bond part, that might be sick. Not dead, because right now we're in an environment where we finally uninverted, or at least about 2 weeks ago, the yield curve uninverted, at least on the 210, I believe. But the yield curve is very flat, and so you're not getting a ton of extra yield or interest from owning longer duration bonds.
Right.
So in that environment,
could you just for a second, could you describe a normal upward sloping yield curve just for the benefit of the listener?
Yeah, I would say maybe a normal interest rate yield environment would be for a 1-year CD or bond, you get something like 3%. For a 3 or 4 year bond, you get 3.5%. For a 10-year, you get 5%, and for a 30-year, 5.5%.
Okay.
It tends to, it doesn't stay at the same slope the entire way, but typically you're assuming that the longer you lend somebody money, the more interest you're going to get.
Yeah.
With kind of a diminishing return after you get to about maybe 5-6 years.
It flattens out towards the extreme end. Okay, good.
Yeah. So I guess that's to just say maybe within that 40 sleeve of this 60-40 that we were talking about, you either have a shorter duration on all of the bonds that you own, or you have a 60-40 within that sleeve where you say, all right, 60% of my bonds, I'm going to have in the more traditional 6-7 year Barclays aggregate duration. And then 40% I'll have in 6-month T-bills or treasuries or something like that.
And that's a really interesting point, because I think, I didn't read the article in the Wall Street Journal, but I can imagine if we're talking about the 2-asset portfolio, it was made famous by a man by the name of J.L. Collins. He wrote a book called The Simple Path to Wealth, where a lot of people had some success. And this is not at all an explicit recommendation for Vanguard products, but they have a total stock market index portfolio and they have a total bond market index portfolio. And so he thought, well, what if I distilled all of my assets down to just this 2-asset portfolio, and I could lever up the risk by just owning more of the total stock market index and less of the total bond market index, and then vice versa. So you could construct a 60-40 by owning all stocks all the time with 60% and owning all bonds all the time with 40%. And so your argument here is, well, from a 30,000-foot view, that looks okay. But if we go in and we actually disaggregate where your proportion of ownership is within that total bond index, how much duration risk are you taking? And is it sensible to be taking all that duration risk all the time? Or could you construct a more reasonable bond portfolio with that 40% of your assets by saying, hey, look, why are you taking duration risk right now when you are absolutely not being compensated for owning longer
duration bonds?
Yeah, so you're 40. People might have made the mistake to mean I ought to own all the bonds all the time, when it's like, well, maybe not. Maybe you could have a slightly more complicated 60-40, and we could talk about the stock side of that as well, because the Vanguard Total Stock Market Index, they actually had to issue an alert or a notice to their shareholders saying, we're accruing some concentration risk here.
Yeah.
Because 30% of that, well, this is actually on the S&P 500 fund, but it's close on the total stock market fund. 30% of that fund is now 7 companies. Yep. 30%. And 50% of the total return on the total stock market came from 7 companies in 2024.
Yeah. And I mean, you have to we have to understand that concentration in the equity market it's a problem that's probably not going to go away anytime soon. I saw another article the other day that in 2024, European stocks outperform U.S. stocks if you take out NVIDIA.
Right.
If you have NVIDIA in there, the U.S. easily defeated European stock.
Yeah.
So 1 and 2, maybe 7 companies are really moving the needle a lot.
Yeah. And then the other thing is, if you disaggregate those returns a little bit further, you discover that 7 companies accounted for not 50% of the return, because remember, that 50% of the return is what it did in aggregate. But piece by piece, some companies lost money. A lot of them did.
Yeah.
So really, those 7 companies accounted for, it's a weird thing, but you can work this out, more than 100% of return of the aggregate. Because it's saying, well, now we have to take that and distribute it over the aggregate to see what it did in total, which was they accounted for 50%. But in reality, that's not even the case.
When that was especially true in 23, I believe the average stock in 23
went down.
Yeah. 24, we broadened out a little bit.
We did. So the equal weighted index did pretty well in 2024. It didn't keep pace with the S&P 500 by a market cap, but it did better than it had done previously. But you have some companies now in this 2-stock portfolio or this 2-asset portfolio where maybe in a bygone era, after index funds had launched, there was a bit of it more, not an equitable distribution, but you get what I'm saying. More companies accounted for more of the return than certainly 7 companies accounting for 50%.
Yeah, the difference between, say, an equal weighted S&P and the S&P
cap weighted,
were not as profound as they are today.
And so that was really what the 60-40 portfolio, was constructed on. I don't think that even Jack Bogle, may he rest in peace, or J.L. Collins would have conceived of a day where you thought, okay, I buy the Vanguard Total Stock Market Index Fund, but really what I'm buying is half of my return is going to come from less than 10 companies or fewer than 10 companies. I think they'd say, well, hang on a second. That's not adequate diversification. You're taking some real risks, and those risks were really manifest in 2022. We got a very unusual interest rate environment. Things went up, they didn't just go up, they went up fast, and stocks really got clobbered that year, and you really saw how this concentration risk could play out. And that may have killed the 60-40 portfolio in that conception of it. But if we're talking about constructing a 60-40 portfolio for an investor today, we're not suggesting a 2-asset portfolio.
Yeah.
And we're not suggesting it for those reasons.
And one thing I'd also like to just kind of touch on, going back to that duration conversation, and why I think in 2022, it obviously did really poorly, but on a go-forward basis, the 60-40 should do a little bit better. One of the reasons for that is, if we go back to the bond side, let's just assume that the average 10-year bond was trading at was at 2% interest at the very beginning of the year, at the bottom of the COVID interest rate period.
That's fair.
It went to 5 very, very quickly. Going from 2 to 5, one of the ways to calculate how much money you could lose is the percentage change in interest rate times the duration. So let's say the duration of the index was 7, interest rates went up 3%. that's about a 21% decline in the value of those bonds less the interest rate. One of the reasons we should be a little bit more durable as we go forward is because all those bonds have now repriced. So if you're buying in today, let's say we're at 5 for interest rates on a 7-year Barclays aggregate portfolio. If we go to 8, so the same distance in terms of movement, I'm not predicting that we will here, you're going to go down by 21% principal, but your returns, your interest coupon every single year is 5 now compared to 2 before.
Yeah.
So in year 1, you'll do 3% better, and hopefully over time you would continue to do a little bit better as bonds were repriced starting from a higher interest rate.
Yeah, because in the falling interest rate environments, particularly like what we were talking about before we hit record, when interest rates were low but going lower, virtually all of your return from bonds came from the capital appreciation of the underlying bond.
Yep.
So you had a bond that you bought at par value, and maybe you had a slight discount, and it now is a premium bond, which you could sell. So again, before we hit record, we were talking about, and a lot of people get this wrong, there's a very distinct difference between being a buy and hold individual bond investor, which is you go out into the marketplace, you buy a 10-year bond, and your point is, I'm going to hold this thing to maturity. How you want interest rates to behave under those conditions is very different than how you might want interest rates to behave if you bought a 10-year bond and you wanted to do what was called riding the yield curve as an example, which is if you imagine a yield curve as downward sloping, you buy a 10-year bond, you take the duration risk of a 10-year bond, say you clip in 5, a year goes by. You have a 9-year bond, but the rate that you're getting on that bond is still 5. And other 9-year bonds might be trading at slight discounts to that. So the price of your 10-year bond has gone up to make those equivalent. So you might have a tactical play there where you could sell your now 9-year bond at a 5% rate for a premium and reinvest at the 10-year. That would be tactical. But if you were going to hold it to maturity, where you're getting all these cash flows from your bond portfolio, we're going to reinvest those. You're either spending them or you're reinvesting them. There is no alternative. They don't just get frozen in amber. And if you're going to reinvest them, you actually might want rates to go up during that period, because then your reinvestments are going to earn a slightly higher coupon.
If you really are truly that buy and hold investor, and the one thing I would add to that is, no, I would argue almost nobody really is that buy and hold bond investor other than maybe like a pension plan. Because the thing is, we are humans and we have eyes and brains. And every month, if interest rates are going up and you claim to be a buy and hold bond investor, you're going to see a lower value on your statement and you're going to feel a certain way about it. That's the same thing with a bond fund. It's the same way with an individual bond. I just don't think an individual really can disaggregate their feeling of, oh man, I'm losing money in this bond, even though I'm planning to hold it for the entire 10 years.
Yeah. Save for default, it is difficult because you know you're going to get 100% of your principal back, but nobody likes seeing an asset they bought trading for 95 cents on the dollar. Even though they're clipping in this case, a $50 coupon per $1,000 per $1,000 bond that they bought, and they're getting a better reinvestment rate of return, it's on a smaller portion of their whole principal or their whole investment that they don't really see how the math shakes out. Now, the math shakes out, the longer the term of the bond, the more you want interest rates to go up while you're accruing those coupons, because the longer period of time you have to reinvest, but the more painful it will be to watch your underlying bond price fall. And I think that's a good segue to be like, those losses for the 60/40 portfolio were very salient to our investors. Yeah. They saw, wow, 2022, the bond side of our portfolio got absolutely clobbered. I think on a go-forward basis, the risk of the 60/40 portfolio is just using it improperly. And one way that you could use it improperly would be owning it at the wrong period of time for you specifically. So if you're young and you're still accumulating or you got an income, 60/40 portfolio probably not the right bet for you.
Yeah.
And the reason it wouldn't be the right bet is, particularly if you're doing annual rebalancing, you're going to be shedding your stock exposure year over year over year. In most cases, sometimes not, but in most cases, and you're going to have foregone returns. And those are really difficult to measure because it's kind of like, how can I be upset about something that I never saw? You know, this wasn't money that left my account. This wasn't, I opened my statements and saw all of a sudden my equities are worth a lot less. It's like, well, no, these are just returns that you could have had if you had just been more aggressive. that you didn't earn because you weren't.
Yeah, and I think you and I both are, there's reasons to rebalance a portfolio, but just for the sake of rebalancing portfolio, I don't think either of us are huge fans of it, especially if you're a younger person and you're investing for a very long time, because that exact reason, the equity market can go up and continue to go up longer than anyone's predicting. I mean, I think you could make that argument about, say, 2012 to 2020. There were constantly articles about this is the end. And, in 2017, I feel like everybody wanted to get out of stocks. And then 18 was a little choppy. 2019 was another banner year going into COVID. So I think 60-40 annual rebalance for somebody who's in their 20s or 30s investing in a 401k, yeah, that we can kill that one.
Yeah. So again, I think when there's a myth out there like the 60-40 portfolio is dead, I think the first question is, okay, compared to what? So it's like you're telling me that the 60-40 portfolio has died, but people were very seldom, and this is not a cut against the Wall Street Journal. They put out good content, but it's very rare that you see a solution to the 60-40 portfolio being dead. Now, the sinister solution might be for us on this podcast, say, well, we can't tell you the answer unless you become a client, at which time we will reveal the portfolio that will replace the 60-40 portfolio and solve all your problems. And before we hit record, Scott, you're saying people treated the 60-40 like it was some panacea, like it was going to solve all of their investment-related woes, and it could never disappoint them. And that was fundamentally incorrect.
I agree. And I think it's also, kind of going that, become a client, and we'll tell you exactly why. Some people may say the answer is, private debt and annuities and stuff like that. And conveniently, they want to sell you private debt and annuities.
Exactly.
So I think there may be an ulterior motive to saying the 60-40 is dead because I don't want to sell you the 60-40% portfolio, as an example.
Mm-hmm. And again, I think the compared to what question is a really good question for clients to ask their whomever is saying that the 60-40 portfolio has died. It's saying, okay, well, what should I be doing other than the 60-40 given my circumstances? And I think all of our clients represent kind of an N of one, or they have a unique portfolio tailored to their needs, but it's certainly within a template. And I think what our practice tries to do is we try to develop a portfolio more based around your unique risk exposures rather than the risk tolerances, which is the sort of ethereal thing about how we feel about asset class returns, whereas your real risk exposure is, in our business at the very least, that's a permanent and unrecoverable loss. So for most people in a 60-40 portfolio who were, I would venture, retirees, this is probably what this publication was geared toward, they might have sustained some permanent unrecoverable losses in 2022, but everybody did.
Yeah.
Unless you had the foresight to convert your entire portfolio to cash, you sustained some permanent unrecoverable losses because you needed some income and your whole portfolio was down, but there was no place to hide.
But if you had, say, just the 60-40, yes, that definitely happened. Hopefully, depending on your allocation, you had something that did a little better than either the Barclays Ag or the S&P 500.
Exactly. And that, I think, is the analysis of the 60-40, as we talked about just a little bit earlier. It needed to be taken a step further. It's saying, well, what was the composition of the 40? If you were all long-term bonds, my goodness gracious, yes, you absolutely 100% took it on the nose.
Yeah.
But if you had shed some of your duration exposure, or if you had, I think, sensibly accrued some of your upcoming expenses in either cash or cash-like securities, or a CD that was going to mature 6 months from then, you did fine. And that would be considered part of your 40. Like, you did great. You came out of that relatively unscathed.
So I think one of the conclusions that we would say is that if the 60-40 must be two indexes that you're never going to touch, we're not huge fans.
No.
But if 60-40 is a general template for allocation that leads to some customization, probably not dead.
No, absolutely not. Because again, before we hit record, we're talking about 60-40 is a little bit like, okay, it's that restaurant that you can always rely on. It's never going to blow you away, but you're never going to have a bad experience. Everybody in this room, everybody listening to this podcast, a restaurant was immediately solicited to mind. where you think, hey, we're going to such and such place tonight. And you're like, oh, great. Yeah, I'm not going to be let down. And I think that that's a wonderful tool to have. But it's probably never going to get you to where you need to go in every single circumstance. Might not be where you take your wife out for your anniversary. She's probably going to leave that dinner a little disappointed. You know what I'm saying? But you are also shedding a lot of risk by going there on just like a regular Tuesday night. Your 60/40 is a solid Tuesday night.
It's a Tuesday night restaurant.
It really is. I mean, again, as you began this podcast with, and I think this is a great point, if you were somebody who had just come into a bunch of money and you had nothing else to go on, nothing, you didn't have an advisor, you didn't know what to do, and you just thought, I really don't want to harm myself irreparably with a selection. If you just dropped it into a 60/40 model portfolio and let it ride for a few years, very unlikely that you're going to just have returns that were so far behind the equity markets that you felt silly, or returns that were just so bad on the negative side where you just took on way too much variability. It's a very unlikely proposition. Yeah. In any market, the 60/40, save for 2022 and parts of 2020 and parts of 2008 when we had that correlation kind of crunch, you did okay. Like that's the way you could describe it. You did fine.
Well, and I think this is a good segue into a big part of investing, whether you're in a 60/40 or something else, or you're picking your own stocks, whatever that is. To thine own self be true to an extent. Unless you are coming say, if you're coming out of college right now, you may not know how you feel about a market correction. But if you've been in the working world for even 5-6 years now, you've experienced some highs and some lows. And in the last 5-6 years, there's been some kind of euphoria. There's been a big downdraft. There's been another short-term one with the COVID downturn. You should know, hey, how did that impact me? Was I able to hold, so to speak, and not make an irrational decision when the market was way down? Or did I realize some losses because I couldn't handle the potential that things might go down further? Mm-hmm. And so if you know that you're that person, then maybe the 60/40 isn't for you. Because if you just realize all your losses at the worst possible moment in a 60/40, you're not gonna have a good time.
No, and I would argue that no portfolio could solve that problem for you. And like we talked about a little bit before, the 60/40 I think people have elevated it to this position of this was like a legitimate investment strategy. This was cooked up in the back room of some lab, and they thought, what we'll deliver to the world? The 60/40 portfolio.
The McRib.
Right, exactly. And this will be the portfolio. It's like, no, guys, the 60/40 portfolio largely was a response to our need as investors for something that would grow at a reasonable rate without giving us too much of a headache.
Yeah.
And that's what the 60/40 was really designed to do. There was nothing special about it. It could have just as well been a 50/50 or a 70/30 portfolio. It just so happened that over the period that it was observed, the 60/40 portfolio was a mean variance optimized portfolio. Really fancy way of saying you got pretty good returns and the volatility was...
The downside was
manageable. And it's like this notion that that's always going to be true for every single investor moving forward, that's really what's dead. The 60/40 portfolio is not dead because they were writing about it as if it were doing a job it was never meant to do. It was meant to satisfy a particular sleeve of investors over a particular period of time.
That was definitely longer than 1 year.
Definitely longer than just 2022 or 2008 or 2020 for parts of it. So it's not dead. I think that myth can be totally busted. I don't think it's dead at all.
Busted.
Scott, Greg, thank you both for taking the time to walk us through this today. And to all those listening, thank you. To make sure you don't miss any future episodes, you can subscribe to the Baird Retirement Management Show wherever you get your podcasts. This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. Robert W. Baird & Co. Incorporated is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. The broadcast may not be reproduced without express permission of Robert W. Baird & Co., Incorporated.